We're nearing an end to the dog days of summer, but there is still much to discuss as far as tactical shifts underway in the U.S. and global markets. And here to discuss them with me now is our chief equity strategist and economist, John Blank. John, there's been a series of sharp market moves down this month. Some say they're in reaction to the tariff situation with China. Others blame the inverted yield curve, forecasting signs of a recession as the cause. What do you say? Are those tactical shifts that you were referring to in a commentary recently?
Actually, no, Terry. What I will tell you is there's two things. They're somewhat related, but not related exactly to what you stated. First of all, there is more uncertainty in the world, and particularly on China. That's broadly defined and seen, but it's uncertainty and not necessarily the tariff situation. Obviously, the tariff situation is behind the uncertainty, so it's kind of mincing words. But I want to point out, really, it's that people don't know what's going to happen as opposed to what has happened. Because ultimately, $500 billion of tariffs from the United States on Chinese imports when we have a $21 trillion economy is still only 3% of our economy. So it's the uncertainty about what's going to happen beyond that that really scares the market. The other thing I want to point out is really I've been calling before for months now that the S&P 500 fair value is 2,900 in the third quarter, and lo and behold, that's about what we're trading at. So we're just range trading around 2,900, which is the other thing that's fascinating is with a lot of volatility, we're really being in a market that's very rational with respect to earnings.
So besides the uncertainty, what are the major market headwinds right now?
Well, first of all, we do have the German situation with the yield curve inversion there, and the worry that Germany will not stimulate their economy enough to pull Europe out of a recession. We also do not know the news from the September 12th ECB meeting, where there's a lot of bets on the table now for big easing there, and that's certainly going to have to happen for the market to be happy. So we were waiting on Europe, basically, Terry, and that's where the real downdraft has come from this time around from Germany.
You mentioned earnings a moment ago. What market impact is going to come from corporate earnings into the second half of the year here?
Well, first of all, Terry, along with corporate earnings being soft, we've seen probably the peak in buybacks about a year ago. So now we don't have as many buybacks, which shouldn't surprise anyone because the tax cut had a one-off effect. And now we're having some, labor market strength that's keeping margins compressed from the cost side. So all in all, what it tells us is it's going to be a struggle for the market to find its way into a higher leg with all this softness. And it's not either bearish or bullish. It's just more evidence that we're going to struggle with a long-term range. We've been trading the S&P flat for 18 months now.
I'm going to go back to a commentary that you wrote recently and pull a quote out from you. Markets are forward-looking, though. There is more hope for a bounce if the market sees an end to the trade war than you may think. The stock market may price in an end to the trade war, believing in an end that comes only at the next presidential election. So presumably you're referring to a regime change in Washington. Is that going to mark an end to the sharp volatility as well?
Yeah, Terry, that's the interesting thing here is, we're in almost September, so we're only a year in front of the election, and the market's 12 months forward-looking. So by December, January of this year, the markets can start to price in a Democratic administration, about the probability of that, and actually rally, not because there's any deal at all, but because there's going to be a deal coming and start to incorporate what that might look like. Just simply getting the tariffs lifted because the regime ended that wanted them would do it. Now, the volatility is a different question because obviously if a very volatile and unpredictable president loses, there's going to be a lot of noise on the way into that election and to that result, and probably after that result. So the point is the volatility is probably going to stay with us, but the outlook will maybe climb that wall of worry as the year goes on.
For the sake of conversation, let's take the flip side. What if a regime change doesn't occur? What would that mean for the markets, either domestically or globally?
Oh, man, that really, the issue there is when and what type of deal gets struck between the U.S. and China. And that may ultimately have to take place with, again, new blood coming into the second term of a Republican administration. I don't think there's going to be the same set of horses at the table for a trade deal on the Republican side if there is not one and the president does win. So in that case, the president just cleans house, gets some new advisors, and maybe that's how a trade deal gets done.
All right. You also say that multiple asset allocation changes need to be unveiled. What does that mean?
Yeah, first of all, I think you got to be a little more bullish on the Russell because of the rotation out of the small caps right now leaves you an opportunity for the Russell right now. I think the Russell's a good contrarian play. I also think overall you've got to start building cash. So I've taken market weights out on the large and mid caps from overweights where I was before. And what I mean by that is just start selling some of your most profitable things and build some cash in mid caps and large caps because this uncertainty is going to carry on, probably going to go spike higher, and you're going to have opportunities, A, to put to work, or B, just to have it packed away. And it's very hard to say put it into bonds because the bonds may well be bottoming while we talk. So cash has to be stronger, and you got to have a bigger pile of it now than you've ever had.
The latest second quarter GDP report, John, showed us the consumer is still solid, but business fixed investment somewhat lackluster. You think the sector ranks this month speak to that? We have a top sector in healthcare, followed by consumer staples and discretionary in that order. And stocks you're eyeing up in the respective areas include DaVita Inc., the Hershey Company, and Best Buy.
Right. DaVita is a great one to point out today. I'm looking at the stock being up almost $1, about 1.8% on a market that's up 1.5%. So DaVita is a healthcare stock, number one rank with an A for value and a B for growth. This is kidney dialysis. This type of stock is going to play on regardless of regime change, regardless of trade. So you got to like DaVita. Hershey, all of you know this one. This is your typical candy bar stock, consumer staple stock. It's been on a nice roll, and you've got an A for growth. For a consumer staple stock to have an A for growth, you don't often see that. Now, the other one I point out is had a really got hammered today. It's on 9.5% to $62 a share. That'll be Best Buy. They just reported today, and they had a soft sales outlook where they narrowed their band of expectations because of the trade war. But again, if you want to play longer term, this is a nice pullback to buy Best Buy, ticker BBY.
Always informative, speaking with our chief equity strategist and economist, John Blank, helping us make sense of what's going on in the global markets. With John, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.